Well, Chad, the economy has been probably in more people's minds in recent months than it has been in years. From your perspective, what are we going to see in the coming months?
Well, we've certainly seen a sharp slowing in the U.S. economy over the past year that intensified the last 2 months. I think most private forecasters are expecting fairly steep declines in economic activity in the fourth quarter, continued difficulties early next year, and then perhaps a rebound in housing and the rest of the economy by late next year.
Is it fair to say that a lot of the woes that we've seen have come from both coasts and are heading inward?
Yes, there's as big of regional differences in economic conditions in 2008 as certainly I remember in my 11 years at the Fed. Definitely the worst hit areas are California, Nevada, Arizona, the upper Midwest, which has been hit hard by auto manufacturing difficulties, and then Florida and the Southeast have had the sharpest increases in unemployment, sharpest declines in home prices. And so far our part of the country has largely avoided anywhere near the scale of difficulties in those areas.
When we start seeing job loss, what does that do to the overall economy?
Well, it obviously hits the people whose jobs are lost. It reduces overall income, reduces overall spending in the economy, which can therefore have impact on other people's jobs and have a bit of a continual downward effect.
Now, I know you're not an oil prognosticator, but in recent months, recent years, oil has been our saving factor, but we've seen it dip down now below $50 a barrel. If oil stays in that $50 range, what does that mean for economies like Oklahoma?
Well, you're right that Oklahoma and really the whole 10th Federal Reserve District, which covers 6 other nearby states, has been outpacing the nation for about the last 4 years, about the period that oil and gas prices have been higher. Now that bit of difference has been removed, as you said, and so that source of relative job growth to the rest of the nation has gone away. We haven't heard of sizable layoffs yet, I don't think, from most of the energy companies. We may not, I don't know. I think the forecast for oil and gas is for, I think, generally some rebound by late next year. And so whether firms take the step of reducing employment remains to be seen. But if oil does stay at about $50, and really the more relevant commodity in Oklahoma is natural gas. Producers are much more natural gas heavy. And both oil and natural gas, meaning natural gas at the wellhead, are probably below current production costs right now. And so that's what's causing the pullbacks in capital spending. At the same time, there should, in the near future, be a reduction in the cost to produce. $50 oil was relatively a high price 3 or 4 years ago. And so as those production costs come back down into line historically, we should, at that level of price, still see decent activity in the intermediate to long run.
Has the weakness of the dollar, has it hurt us or helped us economically?
I would say the timing of when it happened has helped us as a nation. The strength in the U.S. economy, certainly in the third quarter of this year and really throughout 2008, has been the export sector and government spending, largely defense spending. And so that's been good in that it's been a boost to the economy at that time. Now, whether or not that can sustain us going forward, the dollar has strengthened in the last couple of months. Foreign economies have weakened the last couple of months. And so the outlook for exports is probably not quite as good.
Speaking of exports, agriculture is very export dependent. And here in Oklahoma, we've really experienced some very high commodity prices, high energy prices. Rural Oklahoma, is it not doing better than we've seen it do in years?
Oh, I think there's no question. The ag and energy boom has been a boon to rural Oklahoma. But again, the source of that strength has been those high commodity prices that certainly for energy have come back down pretty much all the way from where they started a few years ago. Ag prices still remain somewhat elevated, and still could provide somewhat of a boost. But clearly the surge in activity we've seen the last couple of years is not likely to continue.
Let's talk a little bit more about the national economy. It is so large. The numbers that we hear about bailouts and the money that's being spent by the federal government, it seems almost hard to comprehend. Yet our economy is so large. Is that something our economy can absorb?
Well, certainly we're going to go through a bit of a slow growth period. Forecasts are calling for, like I mentioned, not much growth until perhaps the middle of next year. But eventually we will need more business investment, we'll need more consumer spending. And so once we pass through this period of really of uncertainty, financial market difficulties, we'll be fine in the long run.
And I know this isn't hard science, but how does attitude fit in?
Well, certainly attitude can make a difference, and you know, self-fulfilled prophecies of pessimism can build on itself. And so certainly that's something that we try to combat at the Fed by providing not glorious forecasts of what's going on, but to try to just explain exactly what's going on. And at times I think that's better than is the public perception. Perhaps sometimes it's worse than is the public perception. But I think the overall condition recently has been not great, but perhaps not as bad as sometimes described in the media.
So is it fair to say then that 2009 may not be 2008, but it's also not going to be 1934?
Oh, I think without a question. We're not in a Great Depression type of a situation. Certainly the financial market and credit market difficulties that we've seen are the worst probably since then. But economic conditions, I think we're quite weak at the moment, but we're more in line with more recent economic downturns.
Yeah, we are seeing some job loss here in Middle America, but is it significant?
To date, not really. Job growth has definitely slowed in the middle part of the country. It's still above year-ago levels, but definitely is slowing. But the source of our strength relative to the nation has largely been in natural resources industries. And the prices in those industries have come down to break-even levels. And so therefore that source of job strength has probably gone away. Especially this part of the country, when you say natural resources and oil and agriculture, we're trying to grow our economy out into other things. How are we doing? Well, certainly Oklahoma has become more diversified in the last 25 years. In the last few years, we've probably become a bit more concentrated again just because of the massive growth in natural resources industries, which in a good time is good. And to some degree, diversification is good. Economic studies show that diversification certainly takes out the boom and bust cycles. But areas also want to concentrate in those things that they have a competitive advantage in. And if they have the natural resources available, becoming experts in that is a good thing. In the long run, energy will always be important. Oil and gas may not be important in 150 years, but energy will still be important. And that's what Oklahoma's comparative advantage is in. And so if there was something to concentrate in, I think it would be the broader energy sector.
Whether it be natural gas, biofuels,
right.
Wind, solar.
Right.
Okay. Now in 2008, I think the general public experienced more inflationary pressures than we felt in years.
That's right. The official inflation numbers, even through August and September of this year, were up around 5%, which is the highest we've had in 15 years. And it's related to the run-up in commodity prices that we've seen. And almost certainly in coming quarters, those inflation pressures will subside. But it's certainly something that the Fed always keeps a close eye on. Our mandate is twofold. It's both low and stable inflation and maximum sustainable economic growth. Those are sometimes difficult things to play off against one another. And so inflation was definitely on our radar screen earlier this year. It's always on our radar screen. But the downward pressure of energy prices should begin to bring that down, along with the weakening of the economy overall.